Welcome back to the channel, where we uncover unique opportunities and educational insights in the stock market. Today, we're diving deep into a fascinating situation that's appeared on our hard-to-bar screener, RGNT's Biomaterials Limited, trading under the ticker RGNT. We're going to break down why this stock is capturing attention, what its high cost to borrow means, and what you need to understand about potential short squeeze dynamics. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's zoom in on RGNT. RGNT's Biomaterials Limited is a regenerative medicine company in the healthcare/medical instruments and supplies sector. They're developing and commercializing innovative tissue repair solutions, notably their Joan platform, which uses a hydrogel matrix for treating damaged tissue. With a market cap currently sitting at a modest $17.01 million, RGNT is firmly in small cap territory. Looking at recent price action, it's been a roller coaster. Today, RGNT is down 4.33%. Over the last 5 trading days, it's seen a significant drop of 33.24%. However, stretching back 30 days, the stock is actually up a substantial 46.39%. Joe chart: RGNT 30-day, 5-day, 1-day volume-wise, today's activity stands at 207,900 shares, which is notably low when you compare it to the 30-day average volume of over 11 million shares. In fact, today's relative volume is practically 0x its average. What is cost to borrow and why it matters? Before we get further into RGNT, let's quickly explain one of the most crucial metrics we track: cost to borrow, or CTB. Short text: CTB equals cost to borrow. When you want to bet against a stock, you short sell it. This means you borrow shares, sell them, and hope to buy them back later at a low price, returning them to the lender and profiting from the difference. But borrowing shares isn't free. You pay a fee, known as the cost to borrow, to the lender. This fee is typically expressed as an annualized percentage. Why does it matter? A high CTB indicates that there's strong demand to short a stock, but a very limited supply of shares available to borrow. It's basic supply and demand. When the supply of borrowable shares dwindles and demand remains high, the cost to borrow can skyrocket, often exceeding 100%, 200%, or even several 100% annually, as we'll see with RGNT. Why this stock is hard to borrow right now? This brings us directly to RGNT's Biomaterials. RGNT is flashed on our screener due to an absolutely staggering annualized cost to borrow fee of 757.9%. Think about that: almost 8 times your initial investment just to hold a short position for a year. Highlight CTB 757.9%. While the CTB momentum has seen a slight dip of -2 percentage points over the last 5 trading days, the absolute level remains exceptionally high. Adding to the tight supply, there are currently only about 85,000 shares available to borrow. To put that in perspective, RGNT's estimated float, the number of shares readily available for trading, is around 2.5 million shares. So 85,000 shares is a tiny fraction of the total tradable float. Our internal composite squeeze score, which combines various factors including CTB, momentum, borrow supply, and technicals, currently assigns RGNT a score of 42.7 out of 100. This score indicates a noteworthy, though not extreme, potential for squeeze mechanics to play out. Squeeze mechanics explained. So, what is a short squeeze? Imagine short sellers are paying an exorbitant 757.9% annualized fee to hold their position. If the stock price starts to rise, even a little, these short sellers face a double whammy: their losses on paper increase, and their borrowing costs continue to accrue at an incredible rate. At some point, the pressure becomes too great. To limit their losses and stop paying those sky-high fees, short sellers are forced to cover their positions, meaning they buy back the shares they initially sold. This forced buying creates even more upward pressure on the stock price, triggering more short sellers to cover, and thus, a squeeze unfolds. Joe animation: short sellers scrambling to cover. However, it's critical to understand that a high CTB does not guarantee a squeeze. It can also signal that short sellers have extremely strong conviction in their bearish thesis and are willing to pay these high fees because they are confident the stock will eventually fall significantly. Dilution risk check. When we look at short squeeze candidates, one of the first things we check is dilution risk. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding. This can effectively dilute the value of existing shares, as the company's value is now spread across more shares. Even if a stock is a high cost to borrow and appears ripe for squeeze, significant dilution can flood the market with new shares, making it much easier for short sellers to cover their positions or for new short sellers to enter. This influx of shares can completely offset or negate any potential squeeze thesis. For RGNT, our check found no recent dilutive SEC filings such as SMIN-S1, SMIN-S3, or 424B in the last 90 days. This is a positive signal in the context of a potential squeeze, as it means there aren't immediate, obvious plans for the company to dump a large number of new shares onto the market. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For RGNT, with its 757.9% CTB and only 85,000 shares available to borrow, the mechanics are certainly present for a volatile move. What would we be watching for? First, any catalyst, whether company news, sector-specific developments, or even general market sentiment that could trigger an initial upward price movement. Second, a significant increase in buying volume. Remember, today's volume was extremely low compared to the average. Sustained buying pressure would force short sellers to consider covering their positions. Given the extremely low number of available shares to borrow, even a modest increase in demand to cover could send the price higher rapidly. Keep an eye on the share availability numbers. If they continue to dwindle, the pressure intensifies. However, it is crucial to remember that the stock has seen a significant price drop over the last 5 days despite the high CTB, suggesting current selling pressure or lack of buying interest. So, RGNT's Biomaterials RGNT is undeniably a hard-to-borrow stock characterized by an astronomical 757.9% annualized cost to borrow and a very limited supply of shares. Its small float of 2.5 million shares amplifies the potential for volatility if buying pressure were to emerge. While the absence of recent dilution risk is a positive, the recent negative price momentum and extremely low current volume are important considerations. This situation with RGNT highlights the fascinating interplay of supply, demand, and sentiment in the market. It's a prime example of why understanding metrics like cost to borrow is so crucial for any serious investor or trader. If you found this breakdown insightful, please hit that like button, subscribe for more unique stock analysis, and let us know in the comments below what other hard-to-borrow stocks you'd like us to investigate. We love hearing from you. Thanks for watching, and we'll see you in the next video.